Hello and welcome again, friends and fellow YouTubers. Today, I have very important yet easy to process information for you. Just make sure you watch the video till the end, so you get the maximum benefit out of the information that I am about to share. And if you use professional help, make sure you take notes and don't forget to ask them about these deductions. I have shared all the information in the description section below. Don't forget to take a look at these after the video. So let's get started with the 15 easiest ways to save on your taxes or increase your income tax refund in Canada. Number 1. Invest in Registered Retirement Savings Plan or RRSP. Maximizing your RRSP contributions for the year is one sure way to reduce your taxes regardless of whether you work as an employee or are self-employed. Your RRSP contributions qualify for tax deductions. RRSP tax deductions reduce your tax payable in the year that you claim them and allow you to pay lower taxes. Your contributions in your RRSP grow tax-free until when you withdraw your money in retirement. The great part about this is that your income tax rate in retirement is expected to be lower. Why is that good? That means that your income tax bill should be lower too. You can make contributions for the year until the first 60 days of the year you file the return. For example, if you are filing the tax return for the year 2022, March 1, 2023 is the RRSP contribution deadline. Knowing your income, tax bracket and contribution room can help you decide whether to take action by that date. This could work for you like a top-up based on the TFORs you received for 2022 income. Just make sure you do not over-contribute in RRSPs. You can check the contribution limit in the previous year's notice of assessment. Number 2. If you're a self-employed professional, like driving an Uber or some other small business, then hire your trusted family member as an employee, like a secretary or a bookkeeper, and pay them the salary and make sure you keep the records. You can claim their payroll expenses on your business income and reduce your income tax. At the same time, you still manage to keep the business income within your family. You may need some assistance of a professional on this one. Number 3. Deduct your home office expenses. You can reduce your income tax payable by claiming home office expenses. You choose either one of the options here. Number 1. A temporary flat rate work from home expense claim method. This method was introduced for claiming home expenses, used for office work since the pandemic. You claim up to $2 for every day you worked from home up to a maximum of $400 for 2020 and $500 for 2021 and 2022 each. These methods so far can only be used for these years. You are only eligible to use the new temporary flat rate method if you meet all the following conditions. A. You worked more than 50% of the time from home for at least 4 consecutive weeks. B. You do not claim employment expenses for some other employer for the same duration. C. You were not reimbursed by your employer for these claimed home office expenses. Next. The second one is the detailed method. If you do not meet the criteria, or if you feel that the amount is not sufficient, then you can simply file T2200 or T2200S. This is a detailed method of claiming your home office expenses. Eligible expenses includes rent, utilities, internet fees, supplies, and long-distance calls, etc., and have to be detailed in this form, and please ensure you keep the records proving these expenses. Number 4. Take maximum benefit of your employer's RRSP contribution matching options each year, as long as you're within your annual RRSP contribution limits. You can also get deductions for the pension contribution you made during the year. Number 5. Contribute to Spousal Registered Retirement Savings Plan, RRSP. If you've exhausted your own RRSP limit for the year, you can contribute to your spouse's RRSP if your spouse is less than 71 years old. One drawback of this option is that your contribution limits will be reduced for the following year. For instance, if your spouse is or was on maternity leave and did not utilize their full contribution limits, and if you have surplus funds to invest, then this option can come in really handy. Number 6. This one is for the ones who have kids. You can claim childcare costs for an eligible child or children. The CRA considers an eligible child to be either your child or your spouse's or common-law partner's child under the age of 16 at some point within the tax year. However, if a dependent has an impairment or disability, then the age limit will not apply. The condition here is that you had to incur these costs as a result of your employment, your education, etc. Number 7. Get the home buyer's tax credit. For 2021, first-time home buyers who acquire a qualifying home can claim a non-refundable tax credit of up to $750. The value of the HBTC is calculated by multiplying $5,000 by the lowest personal income tax rate, 15% in 2022. For the year 2022 and the subsequent taxation years, the budget proposed to increase the amount used to calculate the HBTC to $10,000, which would provide a tax credit of up to $1,500 to eligible home buyers. The good news is that this measure has received royal assent. Again, this is only beneficial if you owe taxes, as this is a non-refundable tax credit, used to reduce the amount of taxes you owe. Overall, this amount does not directly translate into your tax refunds, but it can help with increasing your tax refund indirectly for sure. Number 8. Claim the Canada Workers Benefit, CWB. You may be eligible to claim the Canada Workers Benefit refundable tax credit if you work and earned a low income. If you claim this amount when you file your tax return, you might be eligible for a partial, yet advance payment, every quarter, and if you do not claim it, you will automatically be assessed for this when CRA assesses your income tax for the year. Currently, it's $1,395 for single individuals. The amount is gradually reduced if your adjusted net income is more than $22,944. No basic amount is paid if your adjusted net income is more than $32,244. Number 9. Claim tuition fees and other education expenses. You can claim education-related expenses such as tuition fees for post-secondary education in Canada. To qualify, you need to be at least 16 years old by the end of the year. The tuition fees will be eligible for a tax credit if the course is intended to develop or improve your skills for occupational or educational purposes certified by the Minister of Employment and Social Development Canada. Additionally, if you paid fees for an occupational, trade, or professional association examination, you may be eligible for the tuition tax credit. Number 10. Claim interest on student loans. You may be eligible to claim this amount in the current tax year, or the previous 5 years for post-secondary education, if you received the loan through either of the following. A. The Canada Student Loans Act. B. The Canada Student Financial Assistance Act. C. The Apprentice Loans Act. D. Provincial or territorial government laws like the acts above. Number 11. Take advantage of the medical expense tax credit. METC. The METC is a non-refundable tax credit applied through your personal tax return. If you or your spouse or your common law partner paid for eligible medical expenses within a 12-month period ending in the tax year and did not claim them in the previous year, you can claim the medical expense tax credit for the current tax year. Again, even if you do not have to attach certain supporting documents to your return, or if you are filing your return electronically, keep your supporting documents for 6 years in case the CRA asks you to provide them later. Lastly, only expenses in excess of the lesser of $2,479 for 2022, $2,635 for 2023, or 3% of the net income can be claimed for the federal tax credit. The lowest tax rate is applied to the medical expenses to determine the amount of the actual tax credit. Number 12. Deduct spousal and child support payments. Following a separation or a divorce, spousal support payments, made under a court order can be claimed when you file your tax return, and this is a taxable income for the recipient. Child support payments are not considered income to the recipient, in most cases, and amounts paid for child support payments are thus not deductible by the payer. Number 13. Deduct union fees or professional dues. According to the Canada Revenue Agency, CRA, you can claim employment-related expenses such as A. Annual dues for membership in a trade union or an association of public servants. B. Professional board dues required under provincial or territorial law such as engineering members' fees or CPA members' fees, etc. C. Professional or malpractice liability insurance premiums or professional membership dues required to keep a professional status recognized by law. D. Parity or advisory committee or similar body dues required under provincial or territorial law. However, you may not be able to claim expenses for licenses, initiation, special assessments, etc. Number 14. Use the Canada Training Credit to reduce your taxes. As a qualifying student in an eligible educational institution, you can use the Canada Training Credit (CTC) to minimize your tax payable. If you were a resident in Canada for the whole year and were between 26 years and 66 years old at the end of the year, you can claim the CTC for eligible tuition and educational fees. Additionally, you can claim the CTC if you have a Canada Training Credit limit for the current year on the latest notice of assessment or reassessment for the previous year. For every Canada tax credit you claim in a tax year, it reduces your Canada Training Credit limit for future years. Every year, if you file an income tax and benefit return, the CRA will review the criteria and increase your CTCL by $250 if you qualify, up to a maximum of $5,000 in a lifetime. Even in years where you make a claim for the CTC, you can still accumulate $250 in your CTCL for the following tax year. Number 15. This one again is a non-refundable tax credit. Donations. When you make claims on an eligible amount of a gift or donations, the CRA applies a limit that is 75% of your net income. These donations can be used to reduce your tax payable amount, however, these will not be reimbursed if you do not owe taxes in the first place. Again, if you're claiming these, make sure you keep the receipts with you, as CRA can ask for these receipts, going back up to 6 years from the year of filing. There are several other ways, however. I wanted to point out the easiest and most direct ways to reduce your taxes and increase your refund. So that is it for today from me. If you enjoyed today's video, and if you learned even one new topic, make sure you hit that like button, subscribe to my channel, and don't forget to hit that bell icon so you don't miss my future videos about similar topics. Take care and bye for now.